Hello and welcome back to the channel. We've been staying on top of the news just like many of you, and we've begun to see a trend where experts are recommending selling off assets like gold or crypto to buy bonds. We wouldn't normally throw fuel to the fire on something like this, but we can't help but respond to this one. Selling gold to buy bonds is antithetical to a precious metals investor. When I came across these articles, I thought, who is seriously recommending this? We did some digging and we think we found the source of these articles floating around, and we're going to reveal that in this video, but we're also going to give you the top 3 reasons you shouldn't sell your gold in exchange for a portfolio of bonds. Stay tuned. Now, before we begin, please take a moment to like and subscribe to support the channel. Thank you. So one of the strangest pieces of advice I've seen in financial columns recently has been to sell gold to buy bonds. This is just plain odd to me, and I wondered where it was coming from and why someone might recommend it. So we did a little bit of research, dug around, and we have an answer for you. But before we get to why this recommendation is making the rounds and who is making it, we're going to talk about the top 3 reasons not to follow that advice. So the first reason is the most obvious. Gold and bonds are 2 completely different asset classes, and they have 2 different purposes. If you're buying bonds as a fixed income security, then the purpose of that bond is to provide cash flow. That's it. Gold is different. It's an asset class that acts as a store of value and a hedge against hyperinflation and currency devaluation, aka runaway government spending. You're not usually getting a yield from gold, so there's no apples to apples comparison to be made here. If you're investing in gold, you're probably already at least somewhat educated about the history of dollar devaluation, the global monetary system, and the corroding effects of inflation. And you're probably aware of how gold helps to protect your wealth against those things. So why would someone sell a financial instrument that has a very specific purpose as part of a portfolio in exchange for something that has none of those attributes? It's a bit odd to make the leap. All right, that's enough about reason number 1. I think you get the point. Let's talk about the second major reason that exchanging gold for bonds is causing some raised eyebrows over here. And the second reason is that bonds have become unreliable diversifiers. Growing up, I was told to make sure that when I invest in retirement funds or build a portfolio to diversify, get a mix of stocks and bonds so that I'm insulated against a downturn, I was told. Now, the overall advice to diversify is good. Virtually every financial analyst out there recommends diversification as a key part of building your portfolio and sustainably growing your wealth. And the way diversification works is that you put money into assets that are non-correlated. And that correlation part is really important. If 2 assets correlate closely together, then that means when one goes up, the other will too. And if it goes down, so will the other asset. Stocks and bonds are not supposed to correlate, but guess what? During the last couple of downturns, they began correlating. Almost 2/3 of the US population owned stocks directly, so this is highly relevant. The whole point of diversifying into bonds was supposed to be that the value of your bonds would rise as the value of your stocks dropped, cushioning you against a loss. That hasn't been happening. Instead, when the market crashed, bonds did too. If you look at 2022 when the S&P 500 was declining, bonds also declined. The decline was so profound that CNBC declared 2022 the worst year for bonds ever. Now, gold, on the other hand, becomes a more uncorrelated asset when markets experience stress. So gold tends to be a good diversifier, where bonds have been underperforming in their historical role. Now, some of you might be wondering why bonds and stocks started correlating. The most compelling explanation we've heard is the theory of the everything bubble, where debt has been so cheap for so long, it's theorized it has inflated every major asset class. And then when debt became more expensive, it created a decline in performance for everything it was previously holding up. That's enough about reason number 2. Let's move on to reason number 3. The third good reason not to trade gold for bonds is that bonds have been a declining asset class for 40 years. The whole point of bonds is the yield. Yes, you can buy and sell bonds based on the par value, either a premium or discount, but it's really supposed to be a diversified source of fixed income. So we've had a declining bond market since the early 80s, which is a lot of historical performance to look at. In 1981, bond yields peaked. You could get a 15% yield on your 10-year treasury, which was pretty good. I'd happily take 15%. But by 2020, that number had declined to less than 1%. Now everyone is excited that we're seeing yields north of 4% on a 10-year Treasury again, which has occurred on the back of the Fed raising rates to 5.25 to 5.5%. So if the Fed cuts this year, remember they've indicated they could cut 3 times in 2024, what's that going to do to bond yields? Probably cause them to drop again. How has gold fared since the 1980s? Well, you could commonly get an ounce of gold for $400 an ounce throughout the 80s. Gold did fall, and there was a period in the early 2000s where you could even get gold under $300 an ounce. It's now sitting around $2,000 an ounce, and forecasts from most major banks are looking optimistic. JP Morgan is forecasting $2,175 by Q4 of this year. We also have Bank of America putting gold at $2,400 an ounce if the right conditions are met, and UBS is predicting gold at $2,250 per ounce by year's end. Not all banks or analysts think gold is set to sustain new highs. ING, for example, thinks the average price is going to be about $2,031 per ounce this year and average $2,100 per ounce in Q4. Taking historical performance into account, it doesn't make sense to switch from gold to bonds. Bonds simply have not been performing well. So let's get to the finale. Where did all this advice come from? And the articles I dug into a little more closely were heavily quoting hedge fund managers. And according to the Cott report, at the same time these articles began circulating, hedge funds were decreasing their net long positions in COMEX gold and silver futures and increasing their short positions in gold and silver futures. Now the gold and silver markets at the time of filming remains net long, so there's a couple of things that could be going on here. Managers might just be expressing their opinion and the money shows them acting on their opinions. Or they could be trying to tip the scales in favor of where they're moving their money, or it could just be human nature, where someone expresses an opinion to garner support and reinforce their own internal biases. It's hard to say. It's not up to us to speculate on a person's motivations. All we can do is peel back a layer or two to see where the information and recommendations are originating, and then provide that for you to make informed decisions yourselves. And to that end, I do need to provide the standard disclosure. This video, it's just market commentary, does not constitute financial advice. Please seek a professional financial advisor if you are considering making any changes to your investment strategy or portfolios. That's all we have for you today. Please remember to like, subscribe, share with a friend. Thanks for watching, and we'll see you next time.